Hi, good afternoon, everyone. My name is Jared Lopez. I represent Next Generation Trust Services. With me today is Arthur Kavalis and Arthur Roulac, whose company, 3Court LP, specializes in investments in distressed debt and credit-related equities, all of which are allowed within a self-directed IRA. I look forward to hearing about that, and thank you for coming on board, guys. A quick disclaimer. Although Next Generation is working on this presentation with 3Court, we are unable to endorse or recommend any product or company. We strictly provide education on self-directed IRAs themselves, and we bring other companies in to speak to educate our listeners on investments you can make within a self-directed retirement plan. So we'll start off with what is a self-directed IRA. A self-directed IRA is a non-traditional retirement account. So it is the same as your retirement account that you would have with a bigger bank, where your tax-deferred status of your funds still apply. However, when you have a self-directed retirement account, you are allowed to invest in non-traditional assets. Usually these assets are things that our clients already know and completely understand. We do not do the stock market, we do not do bonds, we do not do mutual funds as you would find with typical IRA investments. These retirement plans are made for the bigger banks, and we do the administrative work that's associated with non-traditional assets. So what kind of non-traditional assets are we talking about? Well, these investments are real estate, mortgage notes, precious metals, tax liens, LLCs, hedge funds, and the list goes on and on and on. I'm going to go through a couple of our favorites in the office. One person actually purchased teak and mahogany trees in Costa Rica using their retirement plan. So basically they purchased seeds to these trees and a 15-year contract, and when they're fully grown, cut up and sold and made into her furniture, that's when she'll get a return on her IRA. Now, she's worried about drought, she's worried about flooding, all those sorts of things, but she thinks it's a worthwhile investment. One person actually came in not too long ago and wanted to purchase season tickets and personal seat licenses to the New York Jets within their IRA, which we found out is allowed. Basically, they would purchase the tickets in their retirement plan, they would sell them on StubHub, Craigslist, eBay, wherever they want to sell them. And all of the proceeds, all of the money that comes in goes directly into their IRA. Now, again, there are dealings with disqualified persons, so basically that person couldn't sit in the seat, nor could their parents, grandparents, kids, but it was okay because they were a Buffalo Bills fan, so they didn't want to see the Jets. Some other things you can do, international real estate is really big right now. Obviously distressed debt, as Arthur are going to speak about later. Basically anything you would like. There are some restrictions. You cannot invest in life insurance, and you cannot invest in collectibles. And you also have to watch the dealings with disqualified persons. So please, if you have any questions, I know I'm trying to keep this very brief. We all want to hear what the artists have to say. But please contact me if you have any questions. So why would somebody open a self-directed IRA account? It's the broader selection of allowable investments. It allows our clients to have a more eclectic portfolio. We're not looking to take all of your money and put it into an IRA with us. You should do the stock market, you should do CDs, but you should also be investing in non-traditional assets, things that you know. If you are doing real estate, if you're a realtor and you're doing real estate every day, you should be investing in investment properties with your IRA. It is important, however, to have to be in contact with your administrator like Next Generation Trust Services, or to have a financial advisor that does know the ins and outs of self-directed plans. I'm just going to give our contact information out. It's info, that's INFO, at nextgenerationtrust.com. The website is www.nextgenerationtrust.com. And the phone number here is 973-533-1880. Now, I kept that very short. I'm gonna pass it along to Arthur Roulac and Arthur Kavalis right now. Hi guys, how are you doing?
Great, how are you? Thank you for the introduction. Hello, Jared. Hi everybody.
I'm gonna pass off the presentation to you, and it's all yours.
Great, thank you very much. Hi everyone, I'm Arthur Roulac, and this is Arthur Kavalis. And nice to meet you. Our firm is called Three Course, and I'll just advance the slide to the next page and give you a little overview of what Three Court is and then our backgrounds, and we'll sort of go into explaining a little bit about distressed debt and credit-related equities. First, Three Court is a firm, it's an alternative asset management firm, and we focus on distressed debt and credit-related equities. Credit-related equities we simply define as equities that are driven more by the balance sheet than the income statement. Very simply put, most people think about what earnings are going to be. We think more about how the company is capitalized and how that can drive value or detract from value. On the distressed debt side, very simply defined, would be a piece of debt, whether that's bank debt or bonds trading below 80 cents on the dollar, or 1,000 basis points or 10% above treasuries. Obviously today, the treasury market is trading near zero on the short end and sort of 2% in the 10-year area, so we might define a piece of distressed debt as trading around 12%. Our firm invests in both distressed debt and credit-related equities, and specifically we focus on more middle market opportunities. Just to give everyone a sort of practical example of what we're talking about, I'm sure if you've read the newspaper and your websites recently, you've seen Hostess Brands is going to be liquidated. That would be perhaps a potential investment for us. They have several different types of bank debt trading anywhere between 10 and 15%. You may have read recently the Tribune Company, which owns part of the Food Network, that owns a bunch of broadcasters, and then of course the LA Times, Chicago Tribune is going to emerge from bankruptcy soon. You may not know this, but Caesars Entertainment has bonds trading at 60 cents on the dollar, and also has bonds trading at 90 cents on the dollar. It's just a very good business that has too much debt on it. Nortel Networks is another one that's in bankruptcy that's going to emerge fairly soon. Not as a reorganized business, but simply distributing cash out to people who hold bonds. Another investment today is Lehman Brothers. Obviously, we all know from 2008 that filed, and today Lehman Brothers holds numerous assets, and if you own the bonds, you can those assets accrue to you as they're liquidated. To give you an example, they own a lot of real estate, they own a professional soccer team, they own other investments in private businesses, so it's almost sort of a menagerie, if you will, of various financial assets, and as they liquidate, you get paid out. If you're from the Northeast, you may know Sims Department Stores. They filed recently, and they have a stub piece of equity that basically owns a real estate building downtown that perhaps is interesting. You may know Sbarro is another company. They make pizza primarily in airports and malls, and they restructured recently. And our final example is American Airlines, which is in bankruptcy right now, still operating, but it's going to emerge, and it has bonds trading at 60 cents. So our firm, and this is just a small example of firms that are in bankruptcy or have emerged, our firm seeks to benefit investing in these various situations as they emerge from bankruptcy, get paid. And so that's a general overview of sort of the opportunity set of what we look like. Our firm does, we have institutional investors who invest with us, high net worth families. A little bit about my background, Arthur Roulac. I'm actually originally from the West Coast. I grew up in San Francisco Bay Area. I came back east to college. I went to Colgate University, moved to New York City, worked for a few years, and then went to NYU. I have an MBA from the Stern School of Business with a concentration in finance. I worked at Bank of America Securities for 5 years on their distressed debt desk as a research analyst. I then moved to a large alternative asset management firm called Angelo Gordon. They manage about $20 billion today, and co-founded one of their strategies. From there, I left, set up a firm on my own, which did the same thing I did at Angelo Gordon, which is what we're doing here today, distressed debt and credit-related equities. I sold that business to Citigroup in the beginning of 2008, shortly before the financial crisis. I then left and ran North America distressed debt and reorganized special situations at the New York Securities International. Art and I actually met there, and I hired Art originally to be a senior distressed analyst there, and then we left and founded 3 Court this year, which actually got up and going July 3rd of this year. So we're a new firm, although frankly I've been doing the same type of investing for almost a decade now. I'll let Art Kavalis talk about it.
Yeah, my name is Art Kavalis, and I'm actually originally from Lithuania. I came to the States to go to high school, and then moved to Chicago. And I went to college at Carleton College in Northfield, Minnesota, studied economics there, and then upon graduation moved to Lehman Brothers, and I started in their investment banking analyst program, where I worked as a technology M&A banker for 5 years, and I was promoted to associate. I left Lehman in 2009, and I joined a restructuring firm called CDG Group, based in New York City. And in 2009, there was a lot of restructuring, as you might remember, and I was heavily involved in the restructuring of the automotive suppliers. We ran a number of companies through bankruptcy in 2009, and upon completion of the distress cycle in 2009, I joined Roulac at Nomura, and we were setting up a business there to invest in distressed debt. In 2011, I left to start working on 3 Court, and then we officially launched 3 Court and started investing in July of 2012.
Great, thanks, Art. So we'll go to the next slide, and it's difficult doing this presentation because I know everyone is coming to the investing world with various degrees of sophistication. So, what we're showing on this slide really is if you're in a corporate finance class, your first day of business school or as an undergrad, what you're going to learn is, debt plus equity equals firm value. And what does that mean? A firm value is simply made up of debt that's bank loans or bonds, plus the equity value of the business equals the entire firm value. Most of what 3 Court focuses on is on the debt side of the balance sheet, if you will. And so that's bank loans, which either first lien, second lien, unsecured bonds, or subordinated bonds. And really, all this means is just a simple order in which these securities are paid back. So if you own a common equity, typically speaking, you're at the very bottom of the capital structure. It's the most risky asset. Interestingly, debt tends to be much less risky as a result of that, but of course it all matters on the capitalization. Traditionally, you think of debt investing as income investing, and then you get a return of your principal upon maturity. Key risks, are 2. One is credit risk. Is the business that you've lent to going to deteriorate over time? And is that going to hamper your ability to get paid back, meaning there's no equity value and perhaps your debt is compromised? And then the second, and to a lesser extent in the distressed world, but certainly very important when you're thinking about government bonds or investment-grade bonds, interest rate risk. And obviously, we know we've been in a bull market for interest rates since the early 80s. My old professor, Paul Volcker, at the time had short-term rates at roughly 20%, break inflation coming out of the 70s. We know today, Ben Bernanke's keeping short-term rates at 0. Art and I feel comfortable saying that rates won't go significantly south of 0. We say that tongue-in-cheek. But, really the point we're trying to make is the government's borrowing today at 0 to 2 to 3%. Inflation is running, in our opinion, at 2 to 3%, and I think the government's underreporting inflation. So as a result, your real returns on government bonds are sort of negative. When you're dealing with distressed bonds, certainly you're thinking about that security more as equity than you are as debt, and so interest rate risk isn't so important. So the main thing our firm deals with is credit risk, i.e. we care about deterioration of earnings or improvement of earnings. The other aspect of the firm is just equity. That's, I think, what most people are familiar with. That's, traditionally easily traded over an exchange, easily defined. Usually capital appreciation is through growth and to a lesser extent dividends, although that's more popular today. We'll see what the new tax laws are starting next year on dividends. They've been very favorable. They'll be less favorable going forward, but hopefully better than ordinary W-2 income. What are your key risks in equity? There's no defined maturity. The nice thing about debt is there's a maturity, and if there's a bankruptcy, there's an exit, one way or the other. And so you actually have a stopping point for your investment. In equities, you don't necessarily have that. Earnings deterioration being a big one, and also, of course, you're the riskiest part of the capital structure. You're the last person to get repaid if things go into trouble. The next slide is really talking about traditional approach to investing, and I'm not going to spend a ton of time on this because I think it's somewhat self-explanatory. But normally, bond investors, I think you think about just buying corporate bonds, or you get a coupon back, and then you get your maturity, your principal back at final maturity. The way we tend to approach this in the distress world is buying a bond at par also has a very asymmetric risk return, meaning what? If I buy it at 100 cents on the dollar and all I can get back is 100 cents in a coupon, I have theoretically 100 points of downside and no upside. So we try to change the equation a little bit, and we try to buy things that are at a big discount to par. Sometimes they're paying the coupon, sometimes they're not paying the coupon, but the idea is that we've hopefully the business has already gone through some distress and we're buying it, and we have a reasonable sense of what we think we can get in the future. Also, traditional bond investing is you're going to give someone money to invest in, let's say, a bond fund. You're going to own 200-300 different issues. It's going to be highly diversified, and really you're just getting sort of a market return. If the market goes up, you'll do well. If it goes down, you won't. Equity traditionally is, a long, only approach to equities. People are very focused on the velocity of earnings, so they think about, what are earnings? Are they going to beat or miss? And what's the magnitude of that beat or miss? People look at price-to-earnings ratio. Art and I think price-to-earnings is extremely flawed for a number of reasons. We tend to look at how much cash is a business producing to the underlying equity value of that business, and what's the sustainability of that. So it's sort of taking that income, we'll say, credit approach to equities. And to give you an example, when you have that equities such as, let's say, Facebook, Groupon, or Zynga, which is just sort of the newest crop of technology businesses, as soon as those businesses show a small decline in the velocity of earnings, they just really can get crushed. For Art and I, we tend to be in consumer, non-cyclical names that have more of a balance sheet bet, so we're not so dependent on the income statement velocity of earnings growth. Again, traditional equity view is, if equities are down 45% and I'm only down 40%, that's considered success because I outperformed 5%. Three-course, sort of view to distressed debt and credit-related equities is we care much more about absolute returns than we do on a relative basis. We would sort of view that scenario as a mass failure for us. Finally, too, I think a lot of equity investors are focused on what they're going to get back versus what they're risking. And I think that's very important when you're a distressed debt investor. You think about what I can lose first and what I can make second. We'll go to the next slide. A non-traditional approach to investing is distressed debt. So we sort of talked a little bit about what distress is, but in a nutshell, take any of the companies I've cited earlier on, and maybe an easy one would be to talk about the Tribune Company. Sam Zell took them private in the LBO right at the top of the market. In December 2008, they had bank debt that was issued at 100 cents on the dollar. It dropped to 25 cents on the dollar. Today it's now at around 75 cents on the dollar. And, Art and I think it's actually worth about 125. So we actually think it's worth 25% more than it was originally issued for. And there's a number of reasons for that. The point being, though, is you're buying something after there's been a lot of distress, and hopefully you're in a position to identify what the risks are, and then benefit if the company heals its balance sheet and perhaps does some restructuring. Distress certainly has some cyclicality to it. Some of the big distress cycles were in the early 90s, early 2000s, obviously 2008, 2009, and so sometimes there's more supply, sometimes there's less supply. I'll always say, though, there always are opportunities out there. It's just sometimes it's easier to find than others. Interestingly enough, although the economy's been sort of bumping along at, call it 1 to 2%, there's actually a good amount of opportunity and distress, and certainly more today than there were a couple of weeks ago. And it'll be very interesting to see what happens going forward after some of these tax issues are resolved and what that means for the economy. Types of distressed investments, and I think we've gone over some of these, are distressed performing loans. You can buy distressed performing bonds. You can buy bonds at 85 cents on the dollar. They're still paying you a coupon. So there you have a decent opportunity to have a very high current yield, plus 15 points of price appreciation. Loans that are doing the exact same thing. Convertible securities that are busted, meaning that the convertible strike is so far out of the money that it trades like a debt instrument and no longer like an equity instrument. Post-restructured equity. What does that mean? Essentially, when a company emerges from bankruptcy, usually it has a new capital structure. So it has new bonds and it has new equity. You can buy that equity. Traditionally, people don't follow it. It's misunderstood. And as a taint of bankruptcy, there's a lot of opportunity in that because a lot of people don't look at it and it has the taint of bankruptcy. So although the balance sheet's actually been cleaned up, there's very little debt on it. Operations usually are cleaned up, meaning that in bankruptcy you can reject unfavorable leases, you can fire people much more easily, streamline the organization. So usually the equity, well not usually, sometimes the equity is sort of poised for a big run, but people aren't following it. To give you a good example, you may want to look at Charter Communications, which filed in 2009. It's a cable company. Most people do know it. You look at the stock, Charter's done extremely well out of bankruptcy because they were able to do a lot of these things. They clean up their balance sheet. They're able to finally reinvest in the business, get the triple play going, and then cut a lot of personnel, and then finally spend the money they need to make the business more profitable, and you've seen it do better. Another thing that's actually quite interesting is gift loans. That's debtor in possession. So when a company files for bankruptcy, typically they need new financing, and that's in the form of a DIP. And so that gets a super priority. So that DIP loan is actually paid back before anything else when the company emerges and can typically have very high coupons associated with it. So it may have a 10 to 15% coupon on it, yet the risk of that paper is extremely low because you get paid back first. And it's just like a little niche within distress. And so although that's typically originated at par, it can have a very high current income on it for a fairly de minimis amount of risk. Why can you have good returns in distress? And, distressed debt investing and credit-related equities, like anything else, you need good managers to perform well. However, as a general rule, the asset class has fairly good characteristics with regard to returns, meaning usually you're buying these businesses after they've already cratered. There's asymmetric information, meaning that you go through the reams of bankruptcy filings, you can find very good information about the business, and it takes a lot of work, and you can get an information edge even more so than common equities, because maybe there are only 40 people in the world looking at it versus a traditional bond or stock that may have 4,000 people looking at it. Also, a lot of these funds, we go back to traditional investing, you own a bond fund, and many of them don't have a mandate to hold on to a defaulted piece of paper, and so when they do file, they become forced sellers, driving prices way below its fair economic value. And that also creates, I think, a pretty good return dynamic. We'll go on to the next slide. This is just a little detail about the sort of life cycle of distressed investing. I think if you were on the upper left corner here, the financial stress deteriorating credit ratios, call that your 07 period. Cash flow pressures, bank covenant default, that's 08 period. And then as you start getting down here into the lower part of the curve, you could sort of think about that as the 09 period. Credit gets very tight, the economy contracts. In this case, it was a dramatic contraction, almost 5-6% of GDP, which we hadn't seen in roughly 80 years. The companies file, they heal, i.e. they reject a lot of their debt, or they do a debt for equity swap. Economy can stabilize and start improving a little bit, and then you see these businesses start coming out of that negative cycle, doing much better. And then as those securities start appreciating, then as distressed people were then net sellers of paper. So for us, we sort of we've had a nice 7-8% correction in the equity markets and the credit markets actually. For us, Art and I get much more excited when things are sort of going bad because there's more things for us to do than when they're going well. When they're going well, we're actually not that busy, and when they're going poorly, that's really when we, sharpen our pencils and get to work and find ways to make money. You guys can review this a little bit more, but I don't want to get too much detail, because I think it's fairly self-explanatory. I'm going to have, Art pass. I'm going to pass this over to Art K and talk a little bit about, how we think about distressed investing, the various parts of the capital structure. We've even included one of these massive flow charts on the next slide, which Art puts it up.
For your pleasure.
For your pleasure. You may want to have some coffee before you read that, but Art, go ahead.
But being a distressed investor is basically, you have to answer three main things. One is, how much is there of value? Determine who is going to get that value, and then evaluate how will the business look like post the emergence out of bankruptcy, if there is an emergence. And maybe, sometimes Art and I, just to make it very simple, we say you have to figure out what the pie is worth, how the pie is going to be divided, and then what flavor the pie is going to be after you exit. And it's sort of as simple as that, and also complicated. And the first step is actually probably the most quantifiable aspect of it, but there's somewhat of an art in study figuring out is the value of the asset. And you can approach it four main ways. One is the most basic way is to do a liquidation and evaluate how much the plant, property, and equipment is worth, the tangible and intangible assets. Two is you can actually evaluate what the business's free cash flows could look like going forward and discount them to the present day. Three, you can actually sell the whole business or sell it in parts and base your value on precedent transactions that happen in the marketplace. And lastly, what's very important to realize is that bankruptcy generates a lot of cost to the business. And actually, the longer the business is in bankruptcy, the more drained it is in resources, the less it's able to market itself and carry on as a business. So you really need to evaluate the cost of bankruptcy on the overall enterprise value of the business. And usually, that's something that you have to base your past experience and judgment on. It's not a very clear-cut example. Moving on from the valuation side, in bankruptcy, especially in the United States, there's a very clear delineation of law, in specific bankruptcy code, that discusses how different claims will be treated, and in the bankruptcy process, there is a valuation waterfall, essentially, where the value gets distributed through the creditors and the most senior parts of the capital structure, and then goes to the different levels of priority, getting more and more subordinated. So you go from secured to the statutory priority claims, subordinated claims, and then structurally subordinated claims, and then lastly, if there's any value left, goes to the equity. It is essentially a waterfall of value distribution. And the final step, step 3, is really predicting the outcome of what will the business look like upon emergence. And that is, if the business comes out of bankruptcy. Sometimes bankruptcy processes start in Chapter 11 and they finish in Chapter 7. Chapter 11 assumes that you're going to have a reorganization and there's going to be a going concern. And sometimes you end up going through a liquidation. So Hostess would be a perfect example. go initially through a Chapter 11 process and you try to restructure, and then the restructuring process doesn't go as planned, and then you have no other alternative. You run out of cash, and you have to liquidate the assets, and you go into Chapter 7. The reorganization versus liquidation is something that's really important to evaluate, because businesses that continue to operate generally are worth more because there's an ongoing value of the business. Liquidation value is generally a much lower recovery, but sometimes you can actually have quite substantial recoveries beyond what you've expected. Norco would be a great example, where they sold their intellectual property rights for $9 billion, and most practitioners in the field were very happily surprised about the outcome. But it's important to judge what will be the final outcome of this bankruptcy. I don't want to discuss any further minutia about the bankruptcy law, but I think what's really sort of a distilled version of the Chapter 11 process is laid out on page 9, and we were happy, this is something for you to enjoy and your pleasure reading, but, the key takeaway is, the Chapter 11 process seeks to, rehabilitate the business, discharge the business from excess of debt, restructure it, and make it operationally more viable so it doesn't go into Chapter 11, aka known as Chapter 22, where the business keeps going into another bankruptcy, which would be hosted. Hosted was the second bankruptcy, and now they're turned into Chapter 7, which is a liquidation. So I'll turn it over to Art Roulac, and also open up the floor for questions. We have also a lot of this information posted on our website, www.3courts.com, to see some of our presentation decks and how we review the value investing approach, utilizing distressed data as a means of executing that strategy. Happy to answer questions now, and if you have questions in the future, feel free to email us.
Yeah, I'll add, one thing is a plug is we think the distressed world and we'll say credit-related equities is just sort of a quite fertile place, and a little bit more about credit-related equities before we take questions. Credit-related equities, where we define them, are the equity of businesses that have gone through the Chapter 11 process and have emerged. Recent examples of that would be Six Flags Entertainment, which we were involved in previously, Spectrum Brands, which we were involved in previously. Sabaro even has come out and has private equity, actually. Lyondell, which is a large chemical company. We cited Charter before. And then there are also businesses that we do look at that have more debt on their balance sheet, i.e. they're in, let's say, the high-yield market, the junk bond market. That's how they finance, let's say, acquisitions. And we do look at those as well on an equity side. They're not necessarily distressed, but we typically look at those businesses and say, hey, we're more comfortable with some debt on the balance sheet than other people, simply because that's how we spend our day all day, versus most equity investors don't spend any time thinking about the balance sheet or modeling the balance sheet. Three Court is a firm, we're value investors first, and we just happen to be applying it to the distressed world. What's a value investor? Probably the most famous one that we can cite is Warren Buffett, and that's simply buying businesses for below what you think is fair market value and holding on to them for a long time. We do the same thing in the distressed world and the credit-related equity world. For us, we run a fairly concentrated portfolio. Interestingly, your 20th security you add to a portfolio adds no diversification. So the mutual funds you own that have 60, 70, 80 stocks in them, really you're getting nothing more typically than an equity index return as a result of the diversification. Three Court tends to run roughly 10 to 15 positions, so call it 10% per position, so it's fairly concentrated, so it puts a big onus on us getting things right. We don't use any leverage at all, so we don't borrow any money to improve our returns, and normally we have cash in our portfolio. So when you think about our portfolio is $100, typically we'll have $70 to $75 investing depending on the environment, and if we don't find good opportunities, we may have 50% of that money in cash waiting for something better to return, better to come up from an opportunity perspective. So Art and I sort of say if we avoid the losers, the winners will generally take care of themselves, and we tend to be sort of very thoughtful with what we're doing in terms of research. So, that's our approach. I would argue if you are going to get involved in distressed or credit-related investing, whether it's with us or any manager, make sure the manager has a lot of money invested alongside you, i.e. they've invested in their own funds. Make sure they don't use any leverage. I would also urge you that they have a value orientation and do a ton of work on each position, and they're people that you sort of philosophically aligned with. So, but we're happy to take questions now if you guys have any, and we'd love to continue the conversation. So, I guess maybe the host, you can help us with the question.
Yes, we actually received a few as your presentation was going along. So if you answered these questions, maybe you just want to reiterate it. How does bankruptcy affect, your decision making?
There are a few things. Certain instances will invest in securities before the bankruptcy, and really what does that mean is we're hoping the bankruptcy comes, and perhaps, I'll give you an example, maybe a company has bank debt, which gets paid back first, and it has bonds that gets paid back second. Bankruptcy occurs, many times the bank debt will keep getting paid interest, and then the bonds below you stop getting paid interest, so effectively a company that had a lot of debt, once you file, maybe now has half as much debt, you're at the very top of the capital structure, and so it's actually a real benefit to you. And then bankruptcy otherwise, there are so many questions. It's a very obtuse question. It's a very good one, but there's so many other issues with regard to who are the stakeholders in the business, who are the other funds involved, how do you contemplate restructuring the business, how much debt will it have when it comes out, will it be a Chapter 11, Chapter 7? So we spend a lot of time scenario playing in our heads about what can go wrong before we get involved. Typically speaking, we'll wait for a company to file for bankruptcy, and then we'll invest after the dust has settled a little bit. So we're not early to the situation, unless, of course, we can play the very top, i.e. the thing gets paid back first, and maybe that has a very little bit of debt, and below you there's a lot of debt, and we feel very comfortable that we'll keep getting paid current during bankruptcy. But the short and long answer is, it impacts you completely, and there's a lot of scenario analysis you have to do.
Gotcha. Now, the next question, you mentioned Facebook, Groupon, and one other company. Why do you mention them specifically? Is there anything that you've seen in them that is throwing up a red flag, anything like that?
Well, first of all, we're not invested in any of the three stocks. I think we said Zynga, Groupon, and Facebook. We were mentioning those as an example of names that are in the tech space that had very high valuations when they came to market on an IPO. Facebook was at $40, for example. Now I think it's in the low 20s. But my point of this is those names, if you see just a slight deceleration in earnings growth, typically when they're priced at such a high valuation, those names get killed. And that's what we've seen amongst all three of them. And I was using that as a contrast to a lot of the things that Art and I tend to get involved in with distressed debt, meaning we're not looking for fast-growing businesses. We're looking for slow-growing businesses that have bad balance sheets that can restructure, and we have a pretty good certainty of earnings over time. So we tend to invest in OTC pharmaceuticals, consumer product businesses, food businesses, cable businesses, so things that have a little bit more certainty, low growth, but more certain cash flows.
I'd like to add one more thing, which is this distinction between those three tech companies and being a value investor is that when you're buying these types of tech companies at those valuations at which they went public, you're effectively buying expectations, and you're buying the perceived growth that will happen in the future, versus when you're being a value investor, what you're buying is the fundamental value today without having to expect growth. You're actually getting the asset value, you're getting the free cash flow today, which is producing something now, versus expecting something to be produced in the future in a greater amount. So that's like the most and that's where you can have a lot more margin of safety being an investor and as a value investor, where your downside really is not, when you're not overpaying, you're paying for what it is today and usually getting it cheaper, versus the risk of tending to overpay for something that is very hard to quantify, which is the growth.
But I'll also say Art and I make no comment on those three businesses, just simply that they're examples of IPOs that are all down roughly 50% today. But going forward, we don't have a view on any businesses who've not done the work.
And we haven't invested in any of them.
Okay. The next one I'm going to throw out to both of you guys. So where does the self-directed IRA come into play? Can you explain how it's done within a self-directed IRA?
Yeah, it's pretty straightforward. It's very interesting. Typically, in alternatives, you have to invest in IRA through an offshore vehicle from an IRS perspective, and that's because many alternative funds use leverage and create, as a result of that, income that is not appropriate for an IRA. Since 3 Corp, for example, uses no leverage, we are not subject to those laws. So, simply, actually, I have my IRA invested in 3 Corp, as does Art, through NextGen, actually, which is we're very happy with. And so, from our perspective is, for example, if you have $100 to invest, having $10 to $20, or 10 to 20% of your portfolio in alternatives generally probably makes sense, and if not, 30%. So for us, I would think about distressed debt and credit-related equities as having the profile of equities to a certain extent from a volatility perspective, although I think Art and I would think that C Corp, for example, would be significantly less than that, but to be conservative, I'll say that. And we'll also say that if you're going to invest in any distressed fund, you need to think about that as at least a 5-year investment. That's not to say that the investments are all 5 years, but the cycle can be quite long, and we need time for the investments to work and, fully work themselves through restructuring.
Okay. I think you covered this at the very end, but maybe you want to give a few more distressed debt examples. Maybe things you've invested in the past.
Yeah, so good examples, and I went through some of these at the start, but things we have invested in the past would be a Tribune company, which, we said is actually topical because it should emerge from bankruptcy before the end of this year. We've invested in Caesars Entertainment in the bank loan that hasn't filed for bankruptcy, but we think it will file within the next 2 years. Lehman Brothers, the unsecured bonds. So that's something we call liquidating trust. So it's a bond. Obviously, you don't get a coupon anymore, but what you do get is a distribution every 6 months as they sell assets, and that can be pretty interesting. It's a lower return investment today, but one we think is safe and fairly non-correlated. Others, American Airlines, as we said, is in bankruptcy today. Other investments.
Capmark would be another example.
Capmark is one. Things that we've done over time. Lyondell, Six Flags, Sbarro. We owned the bank debt there previously. And we're trying to hit on more household names that maybe people have actually heard of. Charter Communications is another one, the cable company. So those are some examples. Today things were, we'll give you 2 examples of things we are involved in. One is Tribune, and the other is Lehman Brothers. And typically for us, we do more middle market things. Those happen to be larger capitalized situations that we just think are very attractive or very, very cheap.
Okay, great. Do you want to pass along your contact information? I know you gave your website. Do you want to just mention it?
Yeah, sure. So if you look on the last page here that we have up, you can see, actually our office is located right across from Rockefeller Center on 5th Avenue and 51st Street. And our website is support.com, and you can go there and read more about our investment philosophy specifically and our principles that we founded our business by. We, are very diligent with respect to what we do, and we invest 100% through our own investment vehicle. So if anyone is an investor, you're invested alongside us, and we would, Art and I work very hard for the money that we have, and we view ourselves as guardians of capital first and builders second. But go to 3Court, and there's also information tab there, and you can email us if you're interested in getting more information, our marketing deck or coming business.
And you have a general disclaimer here?
That is our general disclaimer. Our lawyer made us put that on. So please read it, and thank you very much.
Wonderful. I'm just going to pass along Next Generation's information one more time. Again, we do self-directed retirement plans. It's nextgenerationtrust.com. You can email info at nextgenerationtrust.com, and the phone number 973-533-1880. And seriously, I know these guys, they'll be able to take any questions that you have with a smile on their face. So if you have any questions for Art and Art, you can give them a call as well. Thank you so much. We really appreciate it.
Thank you very much.
It's been a pleasure.
It's been a pleasure.